While the week continues after the Fed's first emergency rate cut since 2008, joining us now to discuss is Jim Bianco. He's the president and CEO at Bianco Research. So, Jim, certainly the pressure had been building in markets for the Fed to do something. Were you surprised at all by the timing of yesterday's cut, or was it something that I think most traders, most guys watching Fed funds futures knew was in the cards?
A little bit of both. If you follow Fed fund futures in the market, you'll know that as early as Sunday night, the market was pricing in a cut. It was expecting it Monday. It was expecting it Tuesday. So that part was not a surprise. The surprise might have come that they did it a half hour after the New York Stock Exchange opened. Traditionally, they do those intermeeting moves a half hour before the New York Stock Exchange opened. But nevertheless, this was not the Fed acting preemptively or the Fed acting forwardly. It was the Fed taking its cue from the market and kind of giving it what it wants.
Hey, Jim, as you mentioned, the Fed taking its cue from the market. How long do you think we need to assess whether the cut was successful, I guess I'd say? You see a lot of critics already saying, well, look what happened by the end of the day yesterday. It didn't really help stocks. And yet, you know, those people could also wait a little bit because you would hope that there's some kind of impact on the consumer, right? I mean, it's not just about trying to boost stocks in the short term. I will say what you don't see is anyone yet really saying that this was a success and came at the right time and thank you, Fed.
Right. I think you need to kind of dial back the expectations of what the Fed can and can't do. A rate cut cannot fix this problem. Jerome Powell said that in his press conference, and I don't think anybody at the Fed thought that they were trying to fix this problem. But there are emerging issues in the banking system. There is a bit of a funding squeeze going on in the banking system right now. It's not showing up because the Fed has a repo facility, but it is still there right now. There is also a concern that the market might be in the process of repricing. That's a fancy way of saying it's in the process of going down some more. And the Fed could hopefully manage the decline. And that's been my argument. They're managing a decline. They're not trying to push the market back to new highs. They're trying to prevent a rout. But they do ultimately think that maybe it might continue to go lower. And one of the other reasons that they're easing, and I might add, that the market expects another 50 basis points at the March 18th meeting. So we're 2 weeks away from the next rate cut, if you believe the market, is that there is an expectation of a severe economic disruption coming in the form of school closures, no large gatherings, widespread business closures, and everything else. We might see it in the next day or two come out of Washington State as a precursor to what's going to happen in the rest of the country. As a matter of fact, we even saw it earlier this morning that Italy closed every school in the country as well, too. So that's what I think the Fed was looking at. And this is unusual because what we're not talking about is economic data. You know, tomorrow's the payroll report. Nobody cares about the payroll report. It's an old, you know, we're looking forward and saying, what do we think is going to be the state of affairs in 2 or 3 weeks? And that's why I think they were justified in their move right now, because there is a realistic fear that we could have major economic disruptions coming in the next couple of weeks.
So I got to imagine people sitting here watching you talk and looking at the Dow. Dow's up 4%, and we're hearing you talking about managing a decline. What kind of decline are you expecting? And do you think that the Fed can manage a decline given the tools at their disposal right now?
One first thing is, you're right, the Dow's up 4%. Get used to these kind of moves. I'll go a little technical analysis on you here. Today is an inside day. Yesterday's high was higher than today's. Yesterday's low was lower than today's. So an inside day is what a technician would call an inconclusive day. I know it's 1,000 points, 4%, but it's an inconclusive day. I ultimately think, I'll put it in market terms, right in mid-February, we were trading at a forward PE ratio of 20. To get to that point, we needed to assume phase one of the trade deal was done. We were going to have globalization. We were going to have low inflation. We were going to have low interest rates driven by low inflation. Then this thing comes down, and I ultimately think that there's a high probability that we're going to have a recession, either in the first or second quarter because of economic disruptions coming. We could possibly have a backlash coming out of this of deglobalization, which would mean bringing manufacturing back to the U.S., which would raise its cost, which would be more inflationary. What I'm leading up to is the old 20 PE is now going to be a 12 to 15 PE. That means the market's got to go down 20 or 30%. All right, it went down half that around, about 10 or 15 so far. So we're about halfway there right now. Not down 80%, not down a Great Recession, Great Depression, or anything like that. But we're going to go back to around 2,500 on the S&P, and that might be the new range. That 3,400 we saw 2 weeks ago, that was based on an environment that frankly doesn't exist anymore, thanks to the coronavirus and the coming backlash that we think of deglobalization.
All right, good stuff. As always, Jim Bianco is the president and CEO at Bianco Research. Thanks so much for the time. We'll talk to you soon.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.